Welcome back. Today we're unlocking the easiest way to start investing in Canada, dividend ETFs. If ETF sounds confusing, don't worry. It's just a basket of stocks you buy in one click, giving you instant diversification and lower risk. Dividend ETFs pay you a portion of company profits called dividends just for holding them. That's passive income you can reinvest to grow even more. I'll break down my top 5 Canadian dividend ETFs for 2025, what they are, what they hold, and why they might be perfect for your portfolio. No Wall Street genius required, just simple, smart investing. Grab a coffee, get comfortable, and let's dive in. Here's how to start building wealth the easy way. First up is the Vanguard FTSE Canadian High Dividend Yield Index ETF, better known as VDY. If you're looking for a straightforward way to tap into Canada's top dividend-paying companies, this ETF is a popular choice among both new and experienced investors. Vanguard is famous for its commitment to low fees, and VDY's management expense ratio is just 0.22%. That's much lower than the industry average, so more of your money stays invested and working for you instead of being eaten up by costs. Over the long run, these savings can make a big difference in your total returns. VDY holds a basket of Canada's top dividend-paying companies. Think Royal Bank, TD, Enbridge, and Canadian Natural Resources. These are some of the most established and reliable names in the Canadian market, known for their steady performance and generous dividend payouts. With just one purchase, you're instantly diversified across dozens of blue-chip stocks, mostly in financials and energy. This means you don't have to pick individual winners. VDY does the heavy lifting for you, spreading your investment across leading companies. This diversification helps smooth out the bumps if one sector has a bad year. If, for example, energy stocks dip, your financial holdings can help balance things out, reducing the impact on your overall portfolio. VDY is one of the largest and most traded dividend ETFs in Canada, so it's easy to buy and sell. High trading volume means you can get in or out quickly with minimal hassle or extra costs. The best part? VDY pays dividends monthly, giving you regular cash flow you can reinvest for compounding growth. This steady stream of income is especially appealing if you're looking to build wealth over time or supplement your monthly budget. The yield is consistently attractive, often higher than what you'd get from a typical savings account or GIC. But keep in mind you're heavily exposed to financials and energy, so your returns will be tied to how those sectors perform. That's been a solid bet historically, but you may want to add other ETFs for more sector balance. Spreading your investments across different sectors can help protect your portfolio from unexpected downturns in any one area. VDY is a set-it-and-forget-it investment. Enroll in a DRIP to automatically reinvest dividends and let compounding do the work. Over time, those reinvested dividends can really accelerate your portfolio's growth even if you're starting small. Low fees, instant diversification, and monthly income make VDY a top choice for beginners. It's a simple way to get exposure to Canada's strongest dividend stocks without the stress of picking individual shares. If you want a simple, powerful foundation for your Canadian dividend portfolio, VDY is hard to beat. It's a great building block for anyone looking to grow their wealth steadily and reliably. It's a great way to start your investing journey with confidence. Whether you're just getting started or adding to an existing portfolio, VDY offers a blend of stability and growth potential. Just remember to review your portfolio as you grow and consider adding more sectors over time. As your goals and risk tolerance change, you might want to branch out into other areas for even more diversification. VDY is all about making investing easy and effective. It takes the guesswork out of building a solid dividend portfolio so you can focus on your long-term goals. Let's move on to our next pick and see what else you can add to your investment toolkit. Next is the iShares S&P/TSX Canadian Dividend Aristocrats Index ETF, XEI. XEI focuses on dividend aristocrats, companies that have increased their dividends for at least 5 straight years. This means you're investing in businesses with a proven track record of rewarding shareholders, even during tough times. The result? A portfolio of stable, well-managed companies with a commitment to growing your income. XEI's MR is also just 0.22%, so you keep more of your returns. The holdings overlap with VDY, but XEI's focus on dividend growth gives you a more balanced sector mix. Monthly dividends make it easy to see your passive income in action and reinvest for compounding. The starting yield might be a bit lower than VDY, but the real power is in the growing income over time. XEI is perfect if you want quality, consistency, and the potential for rising payouts. By choosing XEI, you're betting on companies that prioritize shareholders and have the financial strength to keep increasing dividends. It's a smart long-term strategy for building wealth. If you want your income to grow year after year, XEI is a fantastic choice. Let's check out our third ETF. Third on the list is the BMO Canadian Dividend ETF, ZDV. This ETF is a popular choice among Canadian investors who are looking for a reliable source of income, especially those who want to focus on the stability and growth of their dividends over time. ZDV uses a rules-based approach, carefully screening for companies with a solid 3-year dividend growth rate, an attractive yield, and a sustainable payout ratio. This means it doesn't just chase the highest yields, it looks for companies that can actually maintain and grow those dividends year after year. As a result, you get a portfolio of about 50 high-quality Canadian dividend stocks. These are companies that have demonstrated both financial strength and a commitment to rewarding shareholders, so you're not just getting yield, you're also getting stability and peace of mind. Like VDY, ZDV leans toward financials and energy, but its unique screening process tweaks the mix for sustainability. This means you get exposure to some of Canada's biggest sectors, but with a focus on companies that are less likely to cut their dividends during tough times. ZDV has a long track record of delivering consistent income, making it a favorite for income-focused investors. Over the years, it's built a reputation for reliability, which is especially important if you're depending on your investments to cover regular expenses. The MER is 0.38%, a bit higher than VDY or XEI, but still much lower than most mutual funds. For many investors, this small premium is worth it for the added layer of screening and the peace of mind that comes with a carefully curated portfolio. You're paying a small premium for BMO's specific selection process, which aims to balance yield and safety. This approach helps reduce the risk of dividend cuts and keeps your income stream more predictable. ZDV pays monthly dividends, reinforcing the power of regular passive income. For many investors, getting paid every month makes budgeting easier and provides a sense of financial security. It's ideal for those who want a steady, dependable income stream and value a thoughtful, rules-based strategy. Whether you're building wealth or drawing down in retirement, ZDV's approach can help you sleep better at night. If you want a reliable monthly paycheck from your investments, ZDV is a strong contender. It's designed to deliver income you can count on month after month. It's especially appealing if you're nearing retirement or want predictable cash flow. The regularity of the payments can help you plan your finances with confidence, knowing you have a steady stream of income coming in. ZDV is all about sustainable yield and peace of mind. It's a great option for anyone who wants to combine income stability and a disciplined investment process. Ready for something a little different? Let's look at an active approach and see how it compares to these rules-based strategies. Fourth on our list is the Horizons Active Canadian Dividend ETF, also known as HAL. This fund stands out in the Canadian Dividend ETF landscape for a few key reasons. Unlike the other ETFs we've covered, HAL is actively managed by Guardian Capital. That means a team of experienced professionals is constantly researching, selecting, and adjusting the fund's holdings as market conditions evolve, rather than simply tracking an index. The main objective here is to outperform the broader market by carefully choosing high-quality Canadian companies that pay reliable dividends and also have strong growth prospects. The managers look for a balance between steady income and the potential for capital appreciation. With active management, HAL can avoid sectors that are underperforming or facing headwinds, and instead focus on areas with the best opportunities. This flexibility is a big advantage, but it does come at a cost. The management expense ratio, or MER, is 0.67%, which is higher than most passive ETFs. Essentially, you're paying for the expertise of a professional team and the possibility of beating the index rather than just matching it. For some investors, that extra cost is worth it for the chance at higher returns and more strategic decision-making. HAL's portfolio can look very different from a typical passive ETF. The managers have the freedom to overweight certain sectors, like technology or financials, if they see strong potential, or to underweight areas they believe are riskier. Like the other top funds, HAL pays out monthly dividends, which can help keep your cash flow steady and predictable, an important feature for income-focused investors. HAL is best suited for investors who believe in the value of active management and are comfortable paying a bit more for the potential of higher returns. If you want your investments to be guided by a team that's actively monitoring the market, this fund could be a strong fit. It's also a good choice if you prefer having a dedicated team making timely decisions on your behalf rather than relying solely on a set-it-and-forget-it approach. If you value a hands-on approach and trust in the judgment of professional managers, HAL offers a unique and dynamic twist on traditional dividend investing. Just remember, the higher fee and the ups and downs of active management mean you need to be comfortable with a bit more risk and variability in returns. HAL brings both flexibility and professional expertise to your portfolio, giving you access to a carefully curated selection of Canadian dividend stocks. Now let's wrap up this section and move on to our final pick in the lineup. Last up is the iShares Canadian Select Dividend Index ETF, XDV. XDV tracks the Dow Jones Canada Select Dividend Index, focusing on the 30 highest-yielding quality Canadian stocks. This concentrated approach means each company has a bigger impact on performance with a heavy tilt toward financials. XDV is all about maximizing current income, making it a favorite for retirees and anyone seeking a strong monthly cash flow. The MER is 0.55%, higher than VDY or XEI, but you're paying for a targeted high-yield strategy. Monthly dividends make XDV a true income machine, perfect for budgeting and covering living expenses. The trade-off? Less diversification and a big bet on Canada's financial sector. XDV isn't ideal as you're only holding if you're young, but it's a powerful tool to boost yield in a broader portfolio. Think of XDV as a specialist, great at delivering high income, but best used alongside more diversified funds. Its long history and consistent payouts have made it a staple for Canadian income investors. If your top priority is monthly income, XDV is a proven performer. Now let's talk about your next steps. There you have it, 5 top Canadian dividend ETFs for 2025. Each offers a unique strategy, so choose based on your goals, timeline, and risk tolerance. Always do your own research, read fund documents, understand the holdings and fees, and make sure your investments fit your plan. The key is to build wealth steadily and sustainably over time. If you found value in this video, hit like, subscribe, and ring the bell for more investing tips. Drop a comment with your favorite Canadian dividend ETF or one you think I missed. Thanks for watching, and I'll see you in the next video. Start your journey to financial freedom today.